Lecture 5. This lecture covers Chapter 6, Reporting, Analysis, Revenues, Receivables, and Operating Income. In the previous lecture, we talked about how we can analyze the profitability of companies. And in this lecture, we're going to go deeper into the profitability analysis. So if we want to understand profitability, we need to understand income statement. Income statement is a primary source of information about recent company's performance. This information is used to predict future performance, and also income statement is used to evaluate the quality of management. So some of the key issues that people use income statement. Income statement is used to answer these questions. How profitable is a company? How did it achieve the profitability? Okay, and will the current profitability level persist? And we can get answers from income statement. To answer those questions, we cannot just focus on net income because it will not tell us everything. Rather, we must use the various classification within the income statement. So let's talk about income statement classification. First of all, net income can be decomposed into income from continuing operations and income and the gain or loss from discontinued operations. So discontinued operations refers to the operations that the company discontinued during the year. For example, the company can sell one of its divisions during the year. Okay, before the company sells the divisions, there are income from that operations. Okay, that will be reported in this section, net of tax. And when we sell that divisions, okay, there will be gain or losses. So that is also reported in these sections, net of tax. Okay, for sure, discontinued operations, these income or gain or losses will not persist into the next period because they have been discontinued. So what will persist? Okay, income from continuing operations will persist in future period. Income from continuing operations can be further decomposed into operating income, non-operating income, and then provision for taxes. Okay, operating income is from operating activities. These are the primary transactions for companies. It's main business. And operating income is the most important item to look at because if a company wants to be profitable persistently, okay, that is must come from the operating income. Next is non-operating income, which is from non-operating activities. These are the activities, for example, is from the financial or investment activities of a company. Okay, and these activities are from the daily operations. For example, we may have interest income or interest expenses, dividend revenues, gain and losses on sales of securities. These are from the daily operations. However, these operations will not drive the company. What is driving the company is its operating activities or operating income. So both operating income and non-operating incomes are reported before tax. Okay, so we're going to have the tax part. The provision for taxes is the third component for income from continuing operations. Right here are some examples, list items for each of these incomes. Right. So now we have an example of income statement for Amazon. So the item in this orange, inside this orange block is operating items. We start with the product sales, service sales, and these are the Amazon's main business. And the operating expenses include cost of sales, fulfillment. This is if you have a Amazon membership, as delivery expenses is included in this fulfillment. Technology and content marketing, and the general administrative and other operating expenses. So we have the operating income. You can see Amazon's operating income's increasing, although with slower speed, but still increasing, which is good. Which means profitability is increasing, very likely to persist in future periods because its main business is growing. That's not a full picture. We also need to look at non-operating items. They're not the main business, but still sometimes they influence the company's profitability significantly. For example, if you look at Amazon's income statement, although we know Amazon sells software, hardware, services, but from its investment activities, Amazon booked more than $100 billion profit. That's a huge amount of profit from non-operating activities. Although it's not going to drive Amazon's main business, but it's going to influence its profitability significantly. So that is not the case for Amazon. We see for non-operating items, interest income expenses are reported. Also have a provision for income taxes. Okay. And there's no discontinued operations. But there's one more item, equity method investment activities, net of tax. And these are the income from a company's investment in which they do not have a control effect. If they control their the company they invested, it should be consolidated into the financial statement, included income statement. If they have no controlling interest, it will be reported in equity method. Okay, but the idea is very simple. For example, 2021, Amazon has 10% of ownership of company A, and the company A is reporting $40 million income. Okay, and then Amazon, because Amazon owns 10% of the companies, under equity method, Amazon is going to report $4 million, or 10% of $4 million income in its income statement, a net of tax. So the actual Amazon's income is more than 10%. For example, Amazon's, let's say 48%, and 10% of that will be 4.8% income before tax, then deducted tax. That's going to give Amazon 4% income from equity method investment, net of tax, right? So that's equity method investment. Right, so let's talk about income statement. Everything starts with revenue. Right, a company may improve profitability from saving costs, cutting costs, but that cannot solve the problem. Okay, if you want to improve profitability, you have to improve your revenue. And revenue starts with customers' response to a company's product or services. If they like your product services, you're going to have a high revenue. So how do we record revenues? That's revenue recognition. Revenue recognition refers to the timing and amount reported by the company. Okay, there's two things, timing and amount. But revenue recognition can be subject to manipulations by management when they attempt to meet certain performance target, including manipulation of the timing and the amount. So for the next few slides, we're going to talk about revenue recognition issues. For most business, revenue recognition is not a problem. For example, right? You go to a McDonald's, right? You order a meal and you pay for it, and the meal will be delivered in 1 or 2 minutes, and eat meal. That's it. And the company will recognize revenue, right? And you pay for it. So there's nothing to manipulate. However, for some business, the service or the product will be delivered over time, and the payment may not be paid in time, will be paid later. So in those scenarios, there's a lot of opportunity for companies to manipulate. For example, SEC is often concerned about premature revenue recognition. It's about timing of revenue recognition. So what is standards? The core principle of reporting standards is that an entity should recognize revenues to debit transfers of goods and services to customers in an amount that reflect the consideration to which the entity expects to be entitled in exchange for those goods and services. Right? In plain words, right? You have provided service, you have delivered your goods, okay? And you are entitled to receive something in exchange for those goods and services, okay? And this time, you're going to record revenue, regardless whether the customer's paid or not. Okay, to understand the whole process, we need to go through a 5-step process, revenue recognition. There are 5 steps to be followed in implementing the core standards. Step 1, we need to identify the contract with customers. Second is identify the performance obligations. Third is determine the transaction price, followed by allocating the transaction price to performance obligations listed in contract. And finally, recognize revenue when or as entity satisfy performance obligations. So let's talk about these steps one by one. These are very important steps. You understand these steps? Okay, you don't have to remember all these accounting rules. Okay, we can apply these core principles to see whether the revenue should be recognized or not. Right, the word contract, the word in step 1, identify contract with customer. The word contract may involve but not require a legal document. It can be an oral agreement as well. However, regardless of the format of contract, there should be an enforceable right and obligations. Alright, for example, you can randomly send product to random customers, okay, and asking them to make payment if they receive your product. No, you cannot recognize revenues because there's no contract involved, either a legal document or oral agreement. There's no contract. And step 2, we're going to identify performance obligations in the contract. All the performance obligations must be distinct. Okay, there are the deliverable the company agrees to provide to customers. For example, if you sell goods and services separately, those will be viewed as distinct performance obligations. However, sometimes they're not separable. For example, automobile, right? If you purchase vehicle, the new vehicle and the factory warranties, they cannot be separate. Okay, they are always stay together. So in this case, the vehicle and the factory warranty will be viewed as just one obligation. So for the vehicle sales, right, the company can only book one revenues. However, if the company also sells extended warranty, that extended warranty can be separable from the vehicle because they sell those warranties to existing customers. In this case, those are distinct performance obligations. When company sells extended warranties, they can book revenues from those extended warranty sales. Step 3 is to determine the transaction price. It is the amount to which the seller expects to be entitled, okay, when those performance obligations are fulfilled. In this case, we allow for variable considerations. The transaction price will be considered by, for example, price concessions, volume discount, credit, performance bonuses, these kind of things, and requires estimate by management prior to completion of the contract. In case there are multiple performance obligations in one contract, then it is required that we're going to allocate transaction price to those performance obligations in the contract. And we usually adopt the standalone selling price to allocate the performance of the contract. For example, the standalone price for obligation A, let's say $100, obligation B, $100, and in the contract, okay, you give company the contract price, transaction price is $100 for both obligation A and B together. Okay, in this case, we can recognize $50. Okay, selling price for obligation A, and $50 selling price for obligation B, based on the standalone selling price standard. And finally, step 5 requires the entity recognize revenue as it satisfies performance obligations. A performance obligation is satisfied when the customer obtains control of the product or services. Right, for example, a customer obtains the ability to direct the use and obtain substantially all the remaining benefit of the product. Right? Then we're going to see the obligations be satisfied. And sometimes the performance obligation satisfaction will be delivered over time. Okay, then we're going to recognize revenue over time. Deliver at a point of time, then we're going to recognize revenue at a point in time. In many instances, it's easy to determine whether, right, the seller satisfied a performance obligation or not. However, in some cases, it's not. For example, usually we deliver goods to customers and we satisfy their performance obligations. But sometimes, even if we have delivered product, okay, customer may return the product. For example, the fulfillment of contract is contingent based on the product performance, right, or the product approval. If they're not satisfied with the product performance, they will be returned. In some industries, those concerns or those uncertainties are substantial. Many of those products will be returned. So the companies may have to reconsider their revenue recognition. Should they recognize revenue even when they have delivered product to customers? And sometimes they may not recognize revenues because they have not fulfilled obligations, because the product may be returned. But in normal business, those product return will be expected, and that they can be estimated, so it does not affect. In other words, those risks are not substantial, so we can still recognize revenues. We can view those obligations as being fulfilled, and those estimated return will reduce our revenues for sure.